Okay, let's unpack this. We are diving deep today into one of the most, well, I think one of the most fundamentally misunderstood topics on the planet.
Absolutely.
Money, wealth, and the engine that runs them, the capital markets. It
Yeah.
sounds simple, right?
It does. It sounds like something everyone should just intuitively grasp.
Exactly, something everyone thinks they get.
Yeah.
But our source material today suggests that actually very few people truly understand what wealth creation is.
And more importantly, how the sort of architecture of global finance really determines who wins and who loses in the long run.
That's a crucial distinction. The sources we've pulled together today, and this is mostly updated insights from some leading personal finance books, they're tailored specifically for the under 30s audience.
And the goal here is to give you a really comprehensive top-down view.
Right.
We are far less interested in the tactical short-term tips. Things like, oh, you should buy this stock next Tuesday.
Yeah, short Bitcoin this
Yeah,
week.
exactly. It's not about that. It's much more focused on the holistic, the big picture, the evergreen strategies that actually build lasting prosperity.
So our mission today is a true deep dive. It's about cutting through all the noise to give you a framework for understanding the system, not just, participating in it blindly.
And I think if there is one universal principle, one single idea that underpins everything we're going to discuss,
The one takeaway.
the one takeaway you absolutely have to internalize, it's what our research points to as the bedrock of almost every great success story, financial or otherwise.
And that bedrock is.
Compounding. It is the central, non-negotiable insight. If you look at high-performing investment portfolios, world-class personal skills, the sustained growth of the most successful businesses on the planet,
It's always the same story.
it's always the same story. It's a story of compounding that exponential power of growth, building upon previous growth.
Okay, so today we're going to examine the mechanisms of compounding, how to apply that knowledge practically, and then we'll pivot.
Yeah. We'll pivot to address the structural paradoxes that are really challenging global markets today, and it's all geared towards tangible outcomes for you, the listener.
All right, so if compounding is this exponential force that drives wealth, then time has to be the single greatest multiplier.
It is. Time is the fuel.
And that leads us directly to why the updated personal finance guide we're referencing is so laser-focused on people under 30.
The mathematics are, well, they're unforgiving, but they're also beautifully powerful.
Unforgiving how?
In the sense that the sooner you start, the more profound the effect of compounding becomes. We all hear the advice, start early, start early.
Right, it's a cliche.
It's become a cliche, but people rarely grasp the sheer scale of the penalty for delaying. A small amount of money invested early can, and often does, easily outperform a massive amount invested much later.
Okay, let's put some real-world numbers on this, because this is where the illustrative power of the source material really, really shines.
Yeah, let's do that.
Yeah.
Imagine two people.
Let's call them Investor A and Investor B. Same salary, same goals.
Perfect. Okay, so investor A starts saving, say, £5,000 a year at age 25. Investor B delays. They're thinking, oh, I need to save for a wedding, a house deposit, life gets in the way.
The usual stuff.
The usual stuff. And they don't start until age 35, but then they put in the same £5,000 annually.
And we'll assume a realistic average return, let's say 8% a year.
A very standard long-term assumption. The outcomes by age 65 are just radically different.
Okay, lay it on us.
Investor A, who started at 25, contributes a total of £200,000 over 40 years. They end up with approximately £1.45 million.
It's a huge number.
A life-changing number. Now, Investor B, who only contributed $150,000 over 30 years, they end up with only about $610,000.
Wow. That is less than half the wealth.
For just a 10-year delay. That's the unforgiving part. The first 10 years of compounding, that's when the contributions are small, sure, but the time horizon is longest. That's what generates the vast majority of the final exponential growth.
Investor B basically sacrificed those exponential returns and can never really get them back.
You can't. You can't recapture that lost time. Even if you try to get really aggressive later on to catch up, the math just doesn't work that way.
And to really, drive the point home about the power of an early start, even with a single lump sum, the source uses this incredible, striking illustration.
The wealthy relative scenario, it's unforgettable.
So a wealthy relative puts away a pretty modest £5,000 into a diversified investment account the day a child is born.
That's it. One and done. No more contributions, ever.
And if we use that historical benchmark for aggressive long-term assets.
Hmm.
So the long-term rate of return for U.S. equities over the last century.
We're assuming roughly 8% annualized growth. Very conservative.
So what happens to that 5,000 pounds?
That initial investment, left completely untouched for 55 years, would grow to be not far off £1,000,000 by the child's 55th birthday.
We should probably pause there for a second, let that sink in.
Yeah. A single modest investment, never added to again, generates what is essentially generational wealth purely through the mechanism of time and compounding.
Okay, now the immediate critique, the first thing people will say is, what about inflation?
Always.
£1,000,000 in 55 years won't buy what 1,000,000 buys today.
And that's a perfectly valid point, of course, when you're talking about purchasing power, absolutely. But the source material maintains that this calculation is purely an illustration of possibility.
It's about the mechanism.
It's about the mechanism. The power doesn't lie in the nominal value of the £1,000,000. It lies in seeing what capital can do when it's left to work unimpeded for multiple decades.
So the lesson is that the initial effort, no matter how small when you pair it with a really long timeline, it just generates these incredible disproportionate results.
Precisely. And this moves the whole conversation from just, personal finance mechanics to something more like a societal imperative.
Right. The author of this guide is very clear that they see this as a mission.
They do. They argue that financial illiteracy isn't just a personal problem, oh, I'm bad with money. It's a systemic economic drag.
A drag on the whole country.
Yes. They specifically cite the view that widespread financial illiteracy is a major factor contributing to Britain's current economic troubles, its productivity slump.
Which makes sense. If the general populace doesn't get foundational concepts like compounding, risk, asset allocation, they're going to make poor long-term decisions.
And that fundamentally impairs not just their own well-being, but the overall economic stability of the country.
So the mission here is to improve the financial affairs of as many people as possible.
It has to be. By giving young people, the ones with the most time ahead of them, this foundational knowledge, you start creating a positive feedback loop. It's about demystifying wealth creation.
Because the alternative is what we have now.
The alternative is a scenario where this kind of financial knowledge stays locked behind some exclusive gate, which just exacerbates the inequalities that already exist. Giving people this framework is the most effective place to begin.
Okay, so moving from the theory of compounding, which is, pretty abstract, to the practical realities of managing your money.
Yeah.
We arrive at asset allocation.
Yes.
And this is probably the single most important theme that's distilled from the source: live on less, invest the rest. How to think elegantly about dividing up your investment pool.
Asset allocation, it's a fancy term, but it's simply deciding the ratio between your riskier assets.
The stuff for growth.
The stuff designed for higher returns, exactly. And your defensive assets, the things designed to preserve your capital and provide some ballast for when the riskier side, inevitably has a crash.
And the answer the source provides is a really powerful example of that Pareto principle in action, right? The 80-20 rule.
It is. It's the 100 minus your age rule. It's
Yeah.
so accessible, it's simple, and it gets you, 80% of the correct result for 20% of the effort.
It's not a new idea, though.
Oh, not at all. It's a venerable rule of thumb. It dates way back to the 1940s and 50s. It was popularized really heavily by the late Jack Bogle,
Vanguard founder.
the founder of Vanguard, who brought passive index investing to the masses. The calculation is dead simple. You take your current age, subtract it from 100.
And that number is the percentage that goes into high-risk assets.
That's the percentage you allocate to higher risk, high return assets. The remainder, whatever is left, that goes into low-risk defensive assets.
Okay, so let's visualize this for someone listening. If you're 30 years old,
Mm-hmm.
100 minus 30 is 70.
So that suggests 70% of your portfolio should be in aggressive growth assets and 30% in defensive preservation type assets.
And if you're 50, it's a straightforward 50-50 split.
A 50-50 split. And then if you're approaching retirement at, say, 70, that flips completely. 30% aggressive, 70% defensive.
The logic is pretty sound, I have to say. A 30-year-old has 30 or 40 years for compounding to work its magic.
They have decades to recover from major market downturns. They should be prioritizing growth. A 70-year-old, on the other hand, is focused on capital preservation, maybe drawing an income stream. They cannot afford a 40% drawdown. They have to prioritize stability.
But here's where we need to apply a bit of modern critical analysis, which the source material does. The original rule was very specific about what those assets were.
Very specific. Aggressive meant U.S. equities, like the S&P 500, and defensive meant U.S. Treasuries, government bonds.
And that's changed.
The modern world just requires an evolution of that idea. So the source updates this by switching the definitions to simply aggressive stuff and defensive stuff.
High risk, low risk.
High risk, high growth potential versus low volatility preservation. And this allows for much broader asset definitions. It moves you beyond that traditional stocks and bonds binary.
So defensive could now include things like high-quality corporate credit, maybe gold, certain commodities.
Or even just cash instruments, depending entirely on the current interest rate environment.
Right. And speaking of the environment, we have to acknowledge the regulatory context here. Regulators, the FCA in the UK, the SEC in the US, they hate one-size-fits-all advice.
They despise it.
Because they rightly point out that individual circumstances matter enormously. You can't compare a 30-year-old who just sold a tech company for $50 million to a 30-year-old on minimum wage who's still paying off student debt.
And the regulator is absolutely correct in that assessment. There's no argument there. However, the rule of 100 minus your age isn't designed to be, bespoke financial planning from a high-end wealth manager.
Starting point.
It's a foundational framework for the majority, the 90% of people who just need an easy way to understand risk tolerance over time. It gives you a simple, accessible structure that prevents the twin errors of a young person being way too conservative or an elderly person being way too aggressive.
This brings us to a really crucial contemporary critique of the rule, which is the interest rate context.
This is a huge deal.
The rule originated when defensive assets, like long-term bonds or even just a savings account, might have yielded 6%. So if you were 50, your 50% defensive allocation was actually earning you significant real returns.
That is the challenge of the last decade, isn't it? We were all conditioned to near zero interest rates. If your defensive assets are yielding 0.1%, they're barely defensive against even moderate inflation, let alone the high inflation we've seen recently.
So it forces you to ask the question, if rates are that low and inflation's running hot, shouldn't we actually be more aggressive?
Right. Shouldn't the rule be something like 120 minus your age to force more of your capital into growth assets, even if it carries more risk?
That is a sharp, critical question. What's the source material's answer?
The implicit answer is that you have to define defensive differently now. It's not just about yield, but we also have to connect this to the deeper issue, which is monetary debasement and what real rates of return actually are.
Okay, this is critical for anyone listening who really wants to get this. When the source uses the term monetary debasement, what are they referring to specifically?
They are referring to the growth rate of the money supply. So metrics like the M2 money supply relative to the goods and services in the economy. This growth, just by its nature, inherently causes the value of our currency to fall over time.
So it's not just the CPI inflation we see at the grocery store.
No. It's the invisible loss of purchasing power over time that's caused by central bank policy. It's a much bigger, more insidious force.
And how does that affect the defensive part of the portfolio?
Well, think about it. If interest rates rise to 5% today, that sounds fantastic compared to 0.1%. But if the real rate of inflation driven by government spending and the long-term growth of the money supply is actually running at 10%,
Then you're still losing money.
your real rate of return, after you factor in that debasement, is deeply negative. You're losing 5% of your purchasing power every year. So the modern investor has to constantly fight this reality that the value of their currency is falling, which, well, it necessitates a bias towards assets that can outpace that debasement.
Which reinforces the need for that aggressive component even when rates look higher than they were a few years ago.
Exactly. The game has changed.
Okay, let's address the cultural elephant in the room here. There's a deep contemporary skepticism, particularly among younger audiences, towards capitalism and capital markets.
A huge skepticism.
It's frequently portrayed as this inherently extractive zero-sum game that's, fundamentally broken.
And this widespread skepticism is one of the most significant psychological barriers to young people investing. The source material argues that society, just flooded with negative reporting, has simply forgotten what money and wealth truly are.
And why these markets were even invented in the first place.
Yes. The key shift in perspective here is to call capital markets a technology.
The technology, I like that.
It immediately removes the moral judgment. Equities, bonds, futures, these are tools. They are sophisticated technologies that date back to the Dutch and British inventions of the 17th century.
So think about the invention of joint stock companies in the 1600s, like the British East India Company.
Exactly. The core function of this new financial technology was actually elegantly simple. It was about enabling human beings to share risk across large groups.
So if a ship sank on a voyage,
One wealthy merchant didn't lose his entire fortune. The loss was distributed among hundreds, maybe thousands of investors.
and by sharing that risk, it allowed for the mobilization of resources on a massive scale.
A scale never seen before. Suddenly, you could accomplish these incredible feats like funding voyages around the globe, building massive infrastructure projects, developing complex machinery, things that no small group of individuals or even a single monarch could achieve alone.
The proof of this technology's success is, it's all around us.
It is. The source challenges the listener to just look at the tangible fruits of modernity, the internet infrastructure that is delivering this deep dive to you right now.
The fact that we can fly across the globe in pressurized aluminum tubes.
The skyscrapers that define our modern cities, the complex medical diagnostics that save lives, all of it was funded, scaled, and built using the mechanisms of capital markets and risk sharing.
It's the engine that has lifted billions of human beings out of grinding medieval poverty.
Look at the historical trajectory. Stock markets were invented roughly 300 years ago. Just compare the progress of human life, longevity, material comfort since then to the thousands of years that came before. The acceleration is undeniable.
And it's deeply connected to the ability to pool and deploy capital efficiently.
And this brings us to the counter-narrative, right? Countering the press bias that focuses relentlessly on corporate malfeasance. The reality is there are thousands of capitalistic entities doing genuinely amazing, overlooked work.
Particularly in sectors that require immense upfront capital, like biotech.
Precisely. Let's take the specific, really powerful example the source uses to challenge this prevailing narrative. The Boyan-Slat comparison.
Everyone has heard of the high-profile climate activists, but Boyan-Slat, most people probably haven't heard the name.
Boyan-Slat is a young Dutch founder. He observed the immense plastic pollution in the oceans, and instead of just, protesting the industrial output,
He decided to mobilize capital.
he chose to mobilize capital. He founded the Ocean Cleanup, which is a capitalistic entity. It took venture capital funding, raised millions from VCs and Hollywood figures, and deployed that money into a technological solution.
So they didn't just rely on government grants.
No, they used that fast, flexible private capital to research, to develop, and to deploy technology. Specifically, they designed these massive arrays to tackle the Great Pacific Garbage Patch. But, more importantly, for immediate impact.
The river interceptors.
The river interceptors. These are large solar-powered systems designed to be anchored at the mouths of major, heavily polluted rivers in the developing world.
Which are the primary source of most ocean plastic, right?
They're the source of about 80% of it. And these systems capture thousands of kilograms of bottles and debris before they even reach the open sea.
That is capital markets funding a direct, tangible solution to environmental degradation.
It completely shifts the discussion from criticizing the source of the problem to actually funding the solution to the problem.
And we need to broaden our understanding of what biotech is. It's not just about therapeutics or curing cancer.
Not at all. It encompasses massive industrial applications, improving processing power, reducing waste in manufacturing, or even rolling back environmental damage.
Like what?
Well, using hyperaccumulating plants to get heavy metals out of contaminated soil, or developing microbes that can biodegrade plastics and petroleum products. This is progress, and it's driven by capital, risk sharing, and a clear mission.
So this scrutiny of the system, it often lands squarely on the immense wealth of individuals. That famous saying, behind every great fortune is a great crime.
Attributed to Balzac.
It still resonates today, doesn't it? But our source material argues that, while that might have been true during the robber baron era of the 19th century,
Today, wealth creation is primarily driven by providing massive, scalable value.
that is the crucial distinction. The vast majority of modern wealth is created by multiplying value for other people, not by taking value from them.
And the Amazon example is probably the clearest illustration of this dynamic.
Okay, let's analyze Jeff Bezos' wealth. At the time of this source discussion, Amazon's valuation was roughly $2 trillion.
A staggering number.
And Bezos, the founder, owns about 8.6% of the company. Let's just, for easy math, round it up to 10%.
So that 10% stake makes his personal net worth approximately $200 billion.
Right. Now, here's the absolutely crucial insight that the public debate routinely misses.
It's the most important part of the equation.
If Bezos owns 10% of the value, that means the remaining 90% of the value, which is $1.8 trillion.
Was created for everyone else in the world.
And where is that $1.8 trillion sitting? It's not in his pocket.
It's decentralized. It is sitting in the accounts of hundreds of millions of people globally. It's in institutional holdings, mutual funds, ETFs,
The pension accounts of normal workers.
the pension accounts of workers who own S&P 500 funds. Bezos took the immense risk. He worked tirelessly for decades, and as a result, he generated 1.8 trillion in value that flows to the pensions and retirement savings of ordinary citizens around the world.
He was the vector for that colossal value creation.
He was the vector. And this completely refutes the hoarding critique, right? The idea that rich people just keep billions in cash under a mattress.
It has to be deployed.
That capital must be deployed, usually through complex structures like family offices. They are actively funding young entrepreneurs, engaging in philanthropy, and pursuing highly risky, mission-driven projects.
Like Blue Origin.
Bezos funds Blue Origin, pursuing space infrastructure. Elon Musk funds SpaceX. These are multi-billion-dollar deployments of capital that create high-skilled jobs and massive technological breakthroughs.
And those rockets are now integral parts of our internet infrastructure through AWS and Starlink.
It is a constant high-risk cycle of capital deployment, not stagnation.
We also have to push back against this emotional assumption that a billionaire's valuation is real money, as in liquid cash.
It's almost entirely equity, and that equity valuation is highly capricious. It's not based on today's bank balance. It's based on expectations of future earnings, on market sentiment, on complex valuation multiples.
And they are often minority shareholders.
Most of them are. Their wealth exists because the market expects their company to generate immense profit decades into the future.
And that's where you need to understand the real analysis. The source mentions EBITDA. Can you just quickly break that down for the listener? Why is that the litmus test?
That's a great question. EBITDA stands for earnings before interest, dividends, depreciation, and amortization.
Which means?
It's essentially a measure of a company's operating cash flow. How much money the core business is actually generating before you subtract all the non-cash expenses or financing decisions.
And why is that crucial for a growth company, like an early Amazon or Tesla?
Because a high-growth company often chooses to reinvest every single penny it earns back into expansion, R&D. They might intentionally show zero or even negative net profit to minimize tax or just to maximize growth.
So a PE ratio would make them look worthless.
Exactly. But EBITDA strips away those accounting choices and shows you the underlying profitability, the strength of the core operation. And as we mentioned, that value is fleeting. Look at Nokia. It was a 200 billion euro valuation that collapsed almost to zero.
Highly volatile. Which brings us to the key, and I think poorly understood, driver of inequality, according to the source.
The Cantillon effect.
This is maybe the most important concept in the whole deep dive.
I think it is because it fundamentally reframes the modern debate on wealth distribution. The Cantillon effect describes how the inflation caused by monetary expansion does not affect the economy uniformly or immediately.
Okay, so walk us through the mechanism. The central bank engages in quantitative easing money printing. Where does that new money go first?
It enters the economy at the top, through the financial system. Central banks buy government bonds and other assets from commercial banks and primary dealers. This floods the financial system with liquidity.
So the people closest to this new money, the banks, the fund managers, the existing asset holders, they get it first.
They get it first and at its full value.
And they are injecting this new money into financial markets, not directly into consumer wages or Main Street.
Exactly. That new money immediately seeks assets. It drives up the prices of stocks, central London property, high-value art, collectibles. These assets are being priced in a depreciating currency, but because they are scarce, their nominal price just rises sharply.
Which artificially inflates the asset base of the rich.
The people who already own stocks and property, Bezos, Musk. It makes them nominally much, much richer.
And what happens to normal people who don't own large amounts of these assets?
They get the money last. By the time that money trickles down to consumer goods and wages, the asset price inflation has already happened. And worse, they now face higher costs for essential goods and rent because of the resulting consumer price inflation.
So their wages are static, but the cost of living has risen and the asset prices that define the wealth of the rich have exploded.
That is the structural mechanism that drives this bad inequality.
So the argument is that this widening gap isn't caused by simple entrepreneurial capitalism, but by massive state intervention.
It's caused by monetary debasement and artificially suppressed interest rates, which act as a powerful lubricant for the Cantillon effect.
And the source points out that government is currently the biggest percentage of the economy it has ever been.
So Big government relying on this monetary policy fundamentally strengthens the Cantillon effect. It acts as a wealth transfer mechanism that benefits existing asset holders. It's not the fault of the entrepreneurs providing value to consumers.
This structural critique leads us directly to a genuine modern paradox,
Yeah.
what we've called the two-faced dilemma, which is that index funds are fantastic for the average person, but they are structurally problematic for the health of the overall capital market.
This contradiction has to be explicitly acknowledged. For the vast majority of retail investors, using large diversified index funds like the S&P 500 or the MSCI World is absolutely the right move.
This is Occam's razor for investing.
It really is, because, as we established, the knowledge barrier for single stock investing, understanding net debt to EBITDA, short interest, the nuances of intangible assets, it's just too high for most people.
And the data is clear. In the UK, only about 5% of adults have a stocks and shares ISA.
And among those who do, many of them hold just 2 or 3 popular tech stocks, which is disastrously undiversified. ETFs solve this problem beautifully for the individual.
But
The structural problem emerges because of the sheer volume of money flowing indiscriminately into these passive funds. We are talking about trillions globally, from institutional pension funds, from global sovereign wealth funds, and from retail investors seeking easy returns. The flow is immense.
and the mechanism that turbocharges the problem is market cap weighting.
That is the absolute core of the issue. Market cap-weighted index funds dictate that the largest companies in the index receive the largest proportion of any new capital.
So as money flows into an S&P 500 ETF,
That capital is constantly and automatically poured into the biggest companies, Apple, Amazon, Microsoft, Tesla, simply because they hold the largest weights in the index.
and that creates a monstrous self-reinforcing cycle,
It does. The winners get bigger, which means they attract more capital, which means their stock prices rise further, which means they become an even larger percentage of the index.
which attracts still more capital.
It's a feedback loop that drives stratospheric wealth for the top handful of companies and their founders, while severely stifling competition. A new, disruptive company has to fight for scraps of investor attention outside of this massive, passive capital torrent.
And the structural damage caused by this concentration of passive capital is particularly visible outside of the U.S. tech ecosystem. The source provides some really concrete, alarming data about the London Stock Exchange.
Look at the LSE last year. It raised less money from initial public offerings. So new companies coming to the market to raise capital for growth than the stock markets of Oman and Malaysia.
Oman and Malaysia.
London, once a premier global financial hub, fell to 22nd in the world for IPO volume. That is not a healthy market.
And the structural reason for this decline is critical, isn't it?
It is. The dedicated capital that used to fund smaller entrepreneurial British companies, which traditionally came from dedicated UK small cap funds, active managers, institutional investors, that capital is now gone. It has flowed overwhelmingly into global market cap weighted US indices.
So the IPO market, which is the necessary engine for taking a startup and turning it into a scaling national champion.
It has essentially stopped working in the UK. British intellectual property, whether it's biotech, financial software, innovative game developers, it cannot access the capital required for internal growth.
And listing on a dominant exchange like NASDAQ isn't a simple solution for these smaller non-US companies, is it?
No, it's incredibly difficult and expensive. To float on NASDAQ, you're looking at a $5 million ballpark cost just for listing fees, legal fees, compliance. Compare that to maybe £1 million in London in the past.
And that's before you even compete for attention.
Beyond the cost, you're competing with hundreds of U.S. companies for investor attention, you're dealing with different time zones, and you're navigating a complex foreign tax and regulatory regime.
So what's the end result?
The result is a failure of the local capital ecosystem. Instead of scaling up into the next multi-billion-pound company, British IP gets acquired cheaply by American or Japanese businesses.
Leading to a massive loss of high-paid IP-based jobs and future tax revenue for the UK.
The capital simply isn't there to sustain the homegrown engine. It's been hoovered up by the global indices.
Okay, so if the problem is a structural capital deficit in the small to mid-cap growth sector, then the policy focus has to be on creating a thriving ecosystem to fund the next generation of compound effect winners.
The companies that will become the Apples and Amazons of tomorrow, you have to seed them.
The source material proposes a very detailed and, I have to say, highly provocative policy mandate idea to solve both the small cap funding crisis and the long-term pension illiteracy problem at the same time.
The premise is bold, but it's simple. In the UK, there are approximately 600,000 births every year. The proposal suggests the government should give every single newborn child £5,000.
The annual cost is, politically palatable, at least in the grand scheme of things, about £3 billion.
Yes. But the mandate attached to this capital is the ingenious part.
This is the key.
This money must be placed in a tax-sheltered personal account, and it must be untouchable until retirement age, say 55 or 57, to truly maximize that compounding time. And here's the ecosystem engine.
It has to be invested only in UK smaller companies.
Distributed across a diversified basket of perhaps 10 to 12 historically high-performing UK small-cap funds.
So think about the compounding effect of this deployment.
After just 10 years, £30 billion would be flowing directly into the UK small-cap market. That is a transformative amount of capital. This kind of injection could realistically fund 30 new initial public offerings every year at the £100 million level.
And because a £100 million IPO often only represents about 10% of the company's equity.
That means £100 million float can create a company with a £1 billion valuation.
So this policy could potentially create 30 new billion-pound companies within a decade.
All funded by the next generation savings. And crucially, this isn't just speculative. The historical data supports this kind of mandate.
What is it?
The Numis 1000 index, which tracks the 1,000 smallest London stocks, returned an astounding annualized rate of more than 16% from 1955 to 2021.
Wow.
So this demonstrates that we would be leveraging a historically high-performing asset class that is currently starving for capital.
And what are the ancillary benefits of this, beyond solving the pension crisis and creating an entrepreneurial ecosystem?
It solves the financial illiteracy problem at home. Parents, watching the high rate of return on their child's account, would naturally be encouraged to participate in investing themselves.
Yeah.
It could fix the adult financial literacy problem long-term.
That's the ecosystem approach. It uses compounding and a capital mandate to fix a structural economic problem. Now, what's the political friction here?
Well, it would be a large, visible government expenditure, and the political opposition would obviously focus on the annual £3 billion cost and the administrative complexity of managing hundreds of thousands of accounts.
Which leads directly to the counterproposal that's always raised in these debates.
Yeah.
Just tax the rich to redistribute.
Okay.
The source materials note that nearly 80% of the UK population, fueled by the inequality debate we just covered, agrees with the idea of a wealth tax.
But experts who actually understand capital deployment and market dynamics view this idea as, frankly, disastrous.
Right.
It violates the core principle of value creation. Whatever you tax, you get less of. If you tax wealth, which is stored capital, the necessary fuel for future jobs and innovation, you fundamentally discourage the engine of the economy.
A wealth tax would incentivize the individuals who are most mission-driven and efficient at deploying capital to just leave the jurisdiction.
They'd take their intellectual property, their businesses, and their high-paid jobs with them.
Absolutely. When a policy forces wealth to be liquidated to pay a tax, that money is often pulled from productive investments, young businesses, research and development.
You're taxing the engine of wealth, which means you're taxing future tax revenues, future jobs, and ultimately future prosperity. The answer to the bad inequality caused by the Cantillon effect is not more government taxation, but smarter capital deployment like the £5,000 mandate.
We have covered a huge amount of territory today, from the micro decision of using the 100- age rule all the way to the macro structural problems of global capital flows.
We have.
So what is the distillation? What is the ultimate 80-20 takeaway for the individual listener?
The simple distillation, I think, remains. Avoid the complex single-stock speculation unless you have genuine proprietary expertise.
Which most of us don't.
Which 99% of people do not have. Focus on the plain vanilla investment approach. Utilize big diversified index funds, and strictly adhere to that aggressive defensive split, the 100 minus your age rule, while maybe adjusting for the higher risk that monetary debasement introduces. Simplicity and consistency are the alpha generators here.
And when we reflect on the immense wealth gaps we discussed,
Yeah.
the Bezos and Musk valuations, we need to come back to that fundamental mechanism driving those massive gaps.
Yes.
It's not just luck, it's merit times compounding.
This is a phenomenal concept, and it applies equally to personal development as it does to finance. Let's take two university friends, empirically equal in skill and intelligence at age 25. If one of them commits to getting just 1% better every single month, learning a new programming language, improving their fitness, mastering a new sales technique, expanding their professional network,
While the other one just stays static.
the result after 30 years is genuinely staggering.
Go on.
The person who compounded that 1% monthly advantage will not just be 2 or 3 times better off. Through the sheer exponential power of compounding, they will be 35 times better off than their counterpart who stood still.
35 times.
The massive difference is the time and the consistency of the effort, applying that exponential curve to merit. The biggest mistake you can possibly make is interrupting that compounding effect, whether it's in your skills or in your capital.
Which brings us to the perfect, fleshed-out cautionary tale the source material provides. The personal anecdote about interrupting the compounding effect with random, non-diversified investments.
Yes.
Walk us through the mindset behind making that city bonus investment decision.
It was a classic case of what the financial industry calls chasing complexity, and probably a little bit of FOMO, the fear of missing out on something exotic and clever.
The initial success of a career can breed overconfidence.
It really can. The author received a substantial city bonus, and instead of simply putting it into a boring, diversified, globally recognized index fund,
Which would have been the smart move.
the smart, simple move, they decided to invest it in what felt like a unique, smart play land in Montenegro along the coast.
It sounds exotic.
Yeah.
It sounds potentially high return or real estate play in a beautiful emerging region.
Exactly. But it violated every single principle of an evergreen, simple strategy. It was a complex, single-asset, non-diversified, illiquid investment in an uncertain political and regulatory environment. The cash was gone, locked into something that cannot be easily sold.
So what was the ultimate outcome? And what was the feeling of realizing that mistake?
The outcome remains binary to this day, decades later. The land is either worth $2 million or the cash is completely gone, perhaps lost to a questionable land deal or local legal complications involving a, and I quote, jet ski enthusiast in the Balkans.
Oh, no.
And the feeling was just realizing the utter foolishness of interrupting a guaranteed compounding trajectory for a highly specific binary gamble. That simple, diversified strategy would have almost certainly yielded a stable, large, liquid return over that same period.
The lesson for our listeners is clear then.
For most of us, simplicity, consistency, and diversification, letting compounding work its magic on globally recognized liquid assets, it outperforms chasing complex, one-off, high-risk gambles every single time. That is the 80-20 rule in action.
We've journeyed today from understanding the exponential power of a single investment at birth through the necessity of the 100-age rule.
All the way to deconstructing complex market structures, the Cantillon effect, and the true origins of modern wealth inequality.
And that structural conversation leaves us with a really profound, final, provocative question. We established that the Cantillon effect, which exacerbates inequality, is strengthened by government monetary policy.
And that government is currently the biggest percentage of the economy it has ever been.
So this forces us to question efficiency and fundamental structural solutions. When the economy is challenging and inequality is high, is the default answer always more government?
Or should we seriously consider the efficiency gap that we observed when capital is deployed?
Compare the deployment of taxpayer capital through a massive government agency, like the early days of NASA, versus the efficiency and mission focus of private entities like SpaceX.
The evidence is just overwhelming. It suggests a massive efficiency difference when entrepreneurial, risk-sharing private actors, driven by clear missions, deploy capital.
So here is the final thought for you, the listener, to mull over.
If your personal investment choices are, as we've established, part of the societal engine fueling either the status quo or the next generation of innovators, and if the ultimate goal is the creation of maximum value, not merely being a source of tax revenue.
How does your personal mission and the way you deploy your capital contribute to the overall creation of value for society?
Your index fund purchase or your choice to fund a small cap company is a vote in that societal engine. Choose wisely.